In this video, we will discuss the taxation of corporate bonds, municipal bonds, and preferred stocks. For this exercise, we will look at the following fixed income investments: a municipal bond issued by the Austin Independent School District with a yield of 1.99%, a corporate bond issued by Verizon with a yield of 3.15%, and a preferred stock issued by River North Double Line with a yield of 4.75%. For our first exercise, we'll look at an individual investor and ask which of these investments has the highest after-tax yield. The municipal bond has the same after-tax yield as a before-tax yield, at least at the federal level. We will not examine state taxation issues for the purpose of this video, but if we did, then the tax that the investor would pay would be based on not only where the taxpayer is a resident, what state, but also what state or city issues the municipal bond. So at the federal level, the yield will be 1.99% both before and after tax. The corporate bond after-tax yield will equal the corporate bond before-tax yield times 1 minus the personal tax rate of the taxpayer. In this case, we will assume our taxpayer is in the highest personal tax rate, a high-income person with a 39% marginal tax rate. So the after-tax yield will equal 0.0315 times 1 minus 0.37, or 0.01985, or 1.985%. For the individual investing in a preferred stock, the preferred stock will have an after-tax yield equal to the before-tax yield times 1 minus the dividend tax rate. This is assuming that the preferred stock dividends are qualified. If some of them are non-qualified, then you would also have to tax some of it at the personal rate. But for our purposes, we will say they are all qualified dividends. Our taxpayer, again, is in the highest income tax bracket, so we will say that the dividend tax rate is 20%. So we end up with 4.75% times 0.8, or 0.038, or 3.8%. Therefore, if all three of these investments had the same risk, unlikely, then our individual investor would prefer to invest in the preferred stock for a 3.8% rate of return versus the roughly 1.99% rate of return for both the municipal bond and the corporate bond. We are also ignoring the complication in this analysis of the 3.8% extra Medicare tax, which may apply to some of these investments. We will now look at a corporate investor and ask the same question: which investment has the highest after-tax yield? Again, for a corporate investor at the federal level, the municipal bond after tax will be the same as the municipal bond for tax, or 1.99%. And once again, we will largely ignore state tax issues and only look at federal tax issues. For the corporate investor investing in another corporation's bonds, we will say the corporate after-tax yield equals the corporate before-tax yield times 1 minus the corporate tax rate. After the Trump corporate tax cuts, the corporate tax rate is now flat at 21%. So this is going to be 3.15% times 1 minus 0.21, or 3.15% times 0.79, for a after-tax yield of 2.489%, roughly 2.5%. Preferred stocks owned by another corporation different than the issuing corporation are taxed at a rather strange rate. The preferred stock after-tax yield is the preferred stock before-tax yield times 1 minus 0.3 times the corporation's tax rate. So in this case, it's going to be 4.75% times 1 minus 0.3 times 0.21, giving a after-tax yield of 3.753%. In reality, like most things tax, it is more complicated than this, and the 0.3 is actually dependent on what percentage of the corporation is owned by the corporation investing in its bonds, but in most cases it is 0.3, and for most textbooks it is assumed to be 0.3. So again, if we look at a corporate investor, if these three investments have the same risk, the corporate investor would prefer to invest in the preferred stock for the highest after-tax yield. The final question we will ask is at what tax rate would an individual investor receive the same after-tax yield on the municipal bond versus the corporate bond? To determine this, we will set the municipal bond after-tax yield equal to the corporate bond after-tax yield, which is setting the before-tax municipal bond yield equal to the corporate bond before-tax yield times 1 minus the personal tax rate. Solving for TP, we get 1 minus the ratio of the municipal bond before tax divided by the corporate bond before tax, or 1 minus 0.0199 divided by 0.0315 for an individual tax rate of 36.825%. This is very similar to the 37% marginal rate of our high income investor, which is why the yield up here is very close to being the same for the municipal bond versus the corporate bond. This means at this rate, the investor is largely indifferent if they have the same risk between the municipal and the corporate bond. On the other hand, if we had an individual in a lower tax bracket, they would prefer to invest in the corporate bond over the municipal bond. And again, for these purposes, we are ignoring further complications like the possible Medicare tax premium. The data for these bonds came from one of these three sources, emma.msrb.org, which is electronic municipal market access, where we got the municipal bond data. We got our fixed income corporate bond data from the Edward Jones site, and we got our preferred stock data from the Innovative Income Investor site. I thank you for watching this video.